United Arab Bank announced this morning their financial results for the first half of this year, reporting a 45% growth over the same period in 2011, with a net profit of 193 million dirhams, a first in its 37-year history. The UAE-based bank revealed that in June 2012, customer loans and advances increased by 19% to 9.6 billion dirhams from 8.1 billion in December 2011. Customer deposits have also increased by 8% to 8.4 billion from 7.8 billion over the same period. In light of this, UAB officials announced their expansion plans, stating that their aim is to increase from the current 14 branches to 21 branches over the next 6 to 8 months, targeting the more untapped and more potentially lucrative markets such as Abu Dhabi and the Northern Emirates. Officials added that these additional branches will create more job opportunities for both UAE nationals and expatriates.
What we can say about the growth of UAB is that all of our businesses have performed well. So the branch network is an illustration of where we're growing across the country. We're moving from 14 branches up to 21 branches with focus across all of the Emirates, particularly with growth in Abu Dhabi as well. That's a reflection of the growth of the retail business, which has been performing very, very well for the last 2 or 3 years. And we can talk about growth of over 300% in the last 3 years. But that's not forgetting the corporate bank, which is a solid contributor to the growth of the bank generally and the profits as well. Equally, in this year, in Q2, we've been happy to launch the SME business, which is a new business line for us. And we hope that again will provide volumes and profitability going into the next year.
And let's now look at the stock indices across the GCC. Currency markets were mixed this past week as the most recent FOMC meeting left markets disappointed, and a key run of growth figures from China extended doubts of the fragility of the global recovery and kept risk sentiment squarely on the back foot. To tell us more about the week ahead, we earlier spoke with Gaurav Kashyap, the head of the DGCX desk at Al Pari Middle East.
The recent run of data coming out of China, which was weaker across the board, wasn't very surprising to say the least. And I say this because the People's Bank of China, as we all know, surprised markets the week before and introduced a double rate cut to their one-year benchmark lending rate as well as the deposit rate. So the timing of that announcement was very suspicious, and overall markets were very much prepared for a weaker run of data coming out of China. But the main point from this that has to be taken is that the new loans in China increased to 919 billion. This is up from 738 billion, which shows that the recent measures from the People's Bank has had a positive impact on easing measures in the Chinese economy. New loans have increased, which means people are borrowing more and that money is being refiltered into the Chinese economy. So overall, we have to say that the recent moves by the People's Bank have been very impactful on their economy, and we're going to continue to watch next month's readings to see how that figure evolves. But overall, the People's Bank of China will leave the door open to additional easing measures, and this will have a positive impact on risk sentiment as well as commodity markets. The other key headline number from last week, the FOMC meeting, left markets disappointed. Once again, we have Ben Bernanke testifying in front of the US Congress on Tuesday and Wednesday. He's not expected to change too much of his rhetoric. He will be grilled on his views with regards to additional easing. We expect him to protect his views that they do not need to introduce any easing measures, which should keep the US dollar on the front foot.